Welcome to Hibiscus Petroleum's Financial Results webcast. This webcast presents an overview of the results reported as part of our quarterly financial report for the 3-month period ended 30th September 2022 and released earlier today. This webcast has been prepared by Hibiscus Petroleum Berhad or the company solely for general information purposes and shall at all times be heard and or viewed together with the full quarterly report for the same period that has been made available or published by the company on its website. This webcast may contain forward-looking statements which are based on current expectations, beliefs and projections about future events or matters. By listening to and or viewing the webcast, you agree to the limitations and notifications set out in the disclaimer section of this webcast. Our presentation today is split into 4 parts. Part 1 of our presentation presents our key messages and highlights for this quarter, which will be presented by Pascal Hoss, CEO of Hibiscus Oil and Gas Malaysia Limited, a wholly owned subsidiary of the group. Part 2 covers the group's quarterly financial highlights, which will be presented by Yip Chi Yong, or CY, our Chief Financial Officer. The group's operating highlights, offtake schedule and gas sales will be presented by Deepak Thakur, our VP of Economics and Business Planning. Part 3 of our presentation provides a brief outlook on the oil market, which will be presented by Lily Ling, our Senior General Manager of Corporate Development. Part 4 covers the group's financial results, which will be presented again by CY. Should you have any queries, you may contact our Investor Relations team headed by Lily Ling via the email address provided at the end of this presentation. Now, over to Pascal.
Hello, I am Pascal Hoss, CEO of Hibiscus Oil and Gas Malaysia Limited, and here are our key messages for the current quarter. Continued strong oil and gas prices have positively affected the group from a financial results perspective. In the current quarter, we sold approximately 1 million barrels of oil and condensate. Gas was also sold, which amounted to 510,000 barrels of oil equivalent. Going forward, the group's target for the 2023 financial year is to sell approximately 7.2 to 7.5 million barrels of oil equivalent of oil, condensate and gas. In the current quarter, we delivered earnings before interest, taxes, depreciation and amortization, or EBITDA, of 298.4 million ringgit and a profit after taxation, or PAT, of 135.3 million ringgit. The enhanced financial performance of the group has allowed us to reward loyal shareholders. On the 4th of October 2022, we announced a recommendation of final single-tier dividend of 1 cent per ordinary share in respect to financial year ended 30th June 2022, subject to shareholders' approval, which shall be sought at the forthcoming AGM on the 1st of December 2022. Subject to shareholders' approval to be obtained on the 1st of December at an EGM, we have also proposed to purchase our own shares of up to 10% of total issued shares of the company. The proposed share buyback will enable the company to acquire its shares to capitalize any undervaluation, including, inter alia, the realization of potential capital gains if it later resells at higher prices. A new tax regime, namely the Energy Profits Levy, or EPL, was enacted on the 14th July 2022 and took effect from 26 May 2022. On 17 November 2022, the UK government announced changes to the EPL regime effective from 1st January 2023. The revised EPL regime will include an increased levy rate of 35% from 25% on UK oil and gas profits on top of the existing ring-fence corporation tax and supplementary charge. This will mean that the UK upstream oil and gas industry will face a 75% marginal rate of tax. The enhanced deduction for certain categories of capital expenditure to offset against taxable EPL income will be reduced from 180% to 129%, except in the case of decarbonization expenditures, which will retain the 180% enhanced deduction. The EPL regime will now apply until 31st March 2028, and despite it being a tax on windfall profits, the UK government have stated that they do not intend on phasing out the EPL, even if oil and gas price levels move back to more normal levels. At this stage, our intention remains to phase our UK capital expenditure program such that we optimize the incentives offered as part of the EPL being imposed. The EPL amendments are expected to come into law before 31st December 2022. It is also clear that the government is incentivizing decarbonisation initiatives within the UK oil and gas sector, and this will encourage us to identify further opportunities that will reduce our overall carbon footprint. Overall, we are pleased with the progress and performance of the group. That's all from me. Now on to CY with the main financial updates.
Hi, I'm CY, the Chief Financial Officer of Hibiscus Petroleum Group. I'll now take you through an overview of the financial highlights for the current quarter. The group recorded a revenue of 604.8 million ringgit for the current quarter. A total of 1 million barrels of oil and condensate and over 510,000 barrels of oil equivalent of gas were sold. The sale of oil and condensate contributed 502.1 million ringgit to total revenue, while contribution from the sale of gas was 101.5 million ringgit. The relatively strong oil, condensate and gas price levels have contributed positively to the profitability levels in all the group's producing assets in Malaysia and the United Kingdom. The average realized oil and condensate prices achieved by the group in the current quarter of over $110 per barrel, though lower than the previous quarter's $120, remain relatively high. These favorable price levels have been the key driver of our business performance, enabling the group to report a strong EBITDA and PAT for the current quarter, as highlighted earlier. The financial performance of the group in the current quarter continued to be materially impacted by the contribution from the assets acquired from the Repsol Group earlier this year, in January. Our group assumed Repsol's operatorship in all the 5 production sharing contracts acquired, namely the 2012 Kinabalu Oil PSC, the PM3 CAA PSC, the PM305 PSC, the PM314 PSC, and the Block 46 Kainok PSC, or collectively referred to as the Peninsular Hibiscus Group assets. During the current quarter, the Peninsular Hibiscus Group assets contributed 368.2 million ringgit, or 60.9%, to the group's revenue, 183.9 million ringgit, or 61.6%, to the group's EBITDA, and 113.1 million ringgit, or 83.6%, to the group's PAT. In addition to this, both North Sabah and the Anosura cluster continued to perform well in the current quarter. Despite undergoing extensive maintenance activities during the current quarter that were planned and having sold just one offtake of crude oil in the quarter, North Sabah reported an EBITDA and PAT of 56.4 million ringgit and 11.4 million ringgit respectively. As for the United Kingdom, the project to replace the riser that had malfunctioned in May 2021 was successfully completed in the current quarter, and we are pleased to confirm the riser returned to service in September 2022. Consequently, we have seen an increase in production levels which will be more fully reflected in the operational and financial results of the next quarter. Planned maintenance activities at the Anosura Floating Production Storage and Offloading Vessel, or the Anosura FPSO, that commenced in the previous quarter were also completed during the current quarter. In spite of additional costs incurred on these activities, the UK segment achieved an EBITDA and PAT of 69.8 million ringgit and 26.3 million ringgit respectively in the current quarter. A summary of the key financial-based performance metrics are shown on this slide. The net current liabilities position as at 30th September 2022 has dropped significantly from 155.3 million ringgit as at 30th June 2022 to 28.3 million ringgit as a result of the enhanced financial performance and positive cash flows from our producing assets. I will now ask Deepak to continue this presentation with the operational highlights.
Hello, I am Deepak Thakur, VP of Economics and Business Planning. This table shows the operational performance of our North Sabah, Anosura cluster and Peninsula Hibiscus Group assets for this quarter. Focusing on the current quarter ended 30th of September 2022, the North Sabah production facilities recorded an average uptime of 93%. The uptime achieved during the current quarter is higher than that delivered on the preceding quarter. As a result, average gross oil production increased by 7.7% during the current quarter when compared to the preceding quarter, primarily attributable to the completion in August this year of the annual planned major maintenance campaign for the calendar year 2022. Consequently, average OPEX per barrel for North Sabah decreased to $20.56 as compared to the preceding quarter's OPEX per barrel of $27.94. A total of 289,635 barrels of oil net to Hibiscus was sold at an average oil price of $111.54 per barrel in the current quarter, representing a decrease of 6.9% when compared to the preceding quarter's realized average oil price. Hibiscus expects to sell approximately 550,184 barrels of oil in Q2 FY 2023. In terms of expenditure, costs related to seismic processing and interpretation, specialized studies, production maintenance and support services during the current quarter resulted in a capital expenditure of 2.4 million ringgit net to Hibiscus. Over at Anasuria, the average uptime and average daily oil equivalent production rate achieved at the Anasuria cluster for the current quarter of 53% and 1,211 BOE per day respectively are lower than that recorded in the preceding quarter. One crude oil offtake was conducted at Anasuria during the current quarter in which 143,728 barrels of oil net to Anasuria Hibiscus UK was sold at an average realized oil price at $97.12 per barrel. The average OPEX per BOE achieved in the Anasuria cluster for the current quarter of $37.02 per BOE is higher than $27.41 per BOE recorded in the preceding quarter. Our operational performance for the current quarter was affected by a planned offshore turnaround of Anasuria FPSO or the 2022 turnaround, which commenced on 17th of June this year and completed 1 month later. The 2022 turnaround was conducted with the objective of improving the reliability and integrity of the Anasuria FPSO in addition to ensuring a safe offshore working environment. We are pleased with the overall performance of our Anasuria team as the overall shutdown was completed over a period of 30 days against a planned duration of 35 days. In terms of capital expenditure, in the current quarter, Anasuria Hibiscus UK incurred approximately 32.3 million ringgit primarily for the riser replacement project, which has been completed with the riser returning to service in September 2022. As a result of the riser replacement being completed, average gross oil production in October 2022 rose to approximately 7,000 barrels per day compared to the current quarter average of 4,182 barrels per day and the preceding quarter average of 5,566 barrels per day. We expect to see the full impact of this increase in the forthcoming quarters. As mentioned earlier, UK government's announcement on the revised EPL regime effective from 1st January 2023, which will include an increased levy rate of 35% from 25% on UK oil and gas profits on top of the existing ring-fence corporation tax and supplementary charge, will mean that the UK upstream oil and gas industry will face a 75% marginal rate of tax. It is also clear that the government is incentivizing decarbonization initiatives within the UK oil and gas sector, and this will encourage us to identify further opportunities that will reduce our overall carbon footprint. Over at the Kinabalu asset, there was a decrease in the average gross oil production in the current quarter compared to the preceding quarter due to the annual planned major maintenance campaign for the calendar year 2022, which took place from 29th of July to 9th of August 2022. On recommencement of operations, ramp-up of production was delayed as technical problems were encountered on the high-pressure compression. These problems were successfully resolved in the last week of September 2022. As a result of shutdown and subsequent compressor issues, uptime metrics were correspondingly also impacted. Average OPEX per barrel increased to $21.20 when compared to the preceding quarter due to the higher expenditure incurred during the shutdown activities and the lower production cost. Average OPEX per barrel increased to $21.20 when compared to the preceding quarter due to the higher expenditures incurred during the shutdown activities and the lower production post-shutdown. At PM3CAA, average gross oil and condensate production fell by approximately 23% in the current quarter compared to the preceding quarter, mainly due to the annual planned major maintenance campaign for the calendar year 2022, which took place from 20th of August to 2nd of September 2022. The production facilities were shut down for 14 days during this period. Average OPEX per BOE increased to $18 as compared to the preceding quarters OPEX per BOE of $10.16, primarily due to the lower production as well as the expenditure related to topside maintenance, integrity and upgrade activities throughout the quarter, and cost incurred during the annual planned major maintenance campaign. This slide presents the latest estimate of the group's crude oil and condensate offtake schedule and gas sales from our producing assets for the financial quarters ending 31st of December 2022 and 31st of March 2023. During these periods, we estimate to sell a total of approximately 2.1 million barrels of oil equivalent and 1.8 million barrels of oil equivalent of oil, condensate and gas respectively net to the group. For the financial year ending 30th of June 2023, the group is targeting to sell a total of approximately 7.2 to 7.5 million barrels of oil equivalent of oil, condensate and gas. Moving on to the following slide, I will now ask Lily to continue with this presentation.
Hello, I'm Lily Ling, Senior General Manager of Corporate Development at Hibiscus Petroleum. Moving on to part 3 of our presentation today, I will now provide a brief outlook on the oil market. Rystad Energy's outlook for liquid balances for 2023 have eased significantly on the back of downward revisions to demand, which they lowered by 1.1 million barrels per day against the previous forecast to account for a deeper economic slowdown. Rystad estimate next year implied liquid balances building by 0.1 million barrels per day versus the previous bullish call of a 1.2 million barrels per day draw. Oil demand for 2023 has been revised down by 1.1 million barrels per day compared to the previous outlook. Rystad also revised their fourth quarter calendar year 2022 demand forecast to 100.5 million barrels per day. As a result, Rystad estimate global oil demand to increase by 2.3 million barrels per day year-on-year from 99.8 million barrels per day in 2022 to 102.1 million barrels per day in 2023, compared to their earlier estimate of 3.4 million barrels per day. This chart shows Rystad Energy's oil price outlook under their base, bull, and bear cases. According to their analysis, Brent's prices are expected to remain in the range of $90 to $95 per barrel into calendar year 2023 under their base case. Their bull case is mainly supported by announcement of production cuts from OPEC+, which is expected to trim about 1.3 million barrels per day of global oil output in the first quarter of next year. In their bull case, prices could easily reach triple digits in 2023 and as high as $150 per barrel in a post-recession and of COVID-19 restrictions growth period. I will now hand over back to CY, who will go over the financial highlights.
Hello again. As often reiterated in the past, we practice careful management of costs and the efficient delivery of production enhancement projects. This continues to be a critical part of our strategy of maintaining a low unit production cost structure in our producing assets. We also time the implementation of maintenance activities to ensure that positive cash flows are consistently delivered. The group operates or jointly operates its main producing assets, which is a key enabler in allowing us to influence the timing of the implementation of operational activities, supporting our ability to manage the phasing of expenditure. The charts on this slide show the quarterly average realized oil price, unit production costs, and EBITDA margins for both the Anasura cluster and North Sabah over the last 10 quarters. For the Peninsular Hibiscus Group assets, the chart shows the weighted average realized price of both oil and condensate offtakes and gas sales, unit production costs, and EBITDA margins over the last 3 quarters. As clearly shown in the charts, the average unit production costs for the Anasura cluster, North Sabah, and the Peninsular Hibiscus Group assets are all well below the average realized oil price achieved in the respective quarters, delivering sustained positive cash flows. Management's focus remains on continuing this trend of overall performance. The group's revenue is almost fully transacted in US dollars, while costs are mainly denominated in the local currencies of the jurisdictions in which the operating assets are located, namely the Malaysian ringgit in Malaysia and the British pound in the UK. In addition to that, some costs are denominated in US dollars. Accordingly, a strong US dollar bodes well for the group and positively impacts our cash flow and financial performance. The group's financial performance and profitability in the current quarter remain strong on the back of high oil, condensate, and gas prices. As previously mentioned, EBITDA attained by the group
during the current quarter amounted to 298.4 million ringgit, while the PAT was at 135.3 million ringgit. These profits were attained in a quarter where planned maintenance activities were conducted and completed in all of the group's producing assets in Malaysia and the United Kingdom. In the current quarter, the group sold approximately 1 million barrels of crude oil and 510,000 barrels of oil equivalent gas. I would like to firstly highlight the contribution from the two notable production sharing contracts in the Peninsular Hibiscus Group assets on the group's financial performance. Oil revenue and gas revenue from the PM3 CAA PSC achieved in the current quarter were 138.8 million ringgit and 76.9 million ringgit respectively. In addition to the 273,000 barrels of oil and condensate sold at an average oil price of $112.46 per barrel, 491,000 barrels of oil equivalent gas was sold. The EBITDA for PM3 CAA in the current quarter was 128.3 million ringgit, which resulted in an EBITDA margin of 59.5%. PM3 CAA achieved an average uptime of 93% and an average net oil and condensate production rate of 2,279 barrels of oil equivalent per day, recorded while relatively high OPEX per barrel of oil equivalent of $18 was recorded. The operational performance of PM3 CAA was impacted by activities related to the annual planned major maintenance campaign for calendar year 2022, which took place from August 2022 to September 2022. Oil production was further impacted by a production ramp-up delay caused by the mobilization of a drilling rig to the Bunga Raya B platform for an infill well drilling program, and poorer performance from the PM3 North gas injection compressor, which disrupted gas lift supply to the oil wells. Despite the above, profitability for the current quarter was healthy due to the relatively high average selling prices realized for the sale of crude oil and gas. In the current quarter, the PM3 CAA PSC recorded a tax credit of 40.2 million ringgit, which arose from a reversal of an old provision of tax for calendar year 2021. The over provision amount was finalized upon submission of the tax returns to the Inland Revenue Board of Malaysia in August 2022. The next notable production sharing contract in the Peninsular Hibiscus Group assets is the Kinabalu PSC. Kinabalu sold 289,000 barrels of crude oil net to our group at an average oil price of $118.04 per barrel. Kinabalu achieved gross profit of 109.3 million ringgit and a relatively high gross profit margin of 70.9% in the current quarter. The high profitability was due to the high average realized oil price achieved. Kinabalu's EBITDA for the current quarter amounted to 68.6 million ringgit. The EBITDA margin over revenue of 154 million ringgit was 44.5%. The average uptime in the current quarter was 78%. The uptime performance was impacted by activities related to the annual planned major maintenance campaign for calendar year 2022, which took place from 29 July 2022 to 9 August 2022. These activities included an electrical submersible pump change-out and an underwater campaign. There were also issues encountered with the high-pressure compressor tubular bracing installation, which was successfully resolved in the last week of September 2022. Accordingly, the average net oil production rate recorded in Kinabalu was lower at 2,459 barrels per day, while OPEX per barrel was higher at $21.20 per barrel. I would like to highlight that while the Kinabalu PSC was in a taxable position in the current quarter, no provision for taxation was made, as there were sufficient historical tax losses brought forward to completely offset such taxes payable under the Petroleum Income Tax Act 1967 or PITA. Moving on to North Sabah, this segment recorded revenue and gross profit of 146.1 million ringgit and 103.2 million ringgit respectively. These assets sold 290,000 barrels of crude oil net to Sea Hibiscus. These barrels were sold at an average oil price of $111.54 per barrel. North Sabah's average OPEX per barrel of $20.56 per barrel included amounts incurred for the annual planned major maintenance campaign for calendar year 2022. The campaign commenced in March 2022 and was completed in August 2022. The average uptime achieved in the current quarter was 93%, while the average net oil production rate was 4,732 barrels per day. A high average realized oil price, coupled with careful management of costs and efficient operational performance, resulted in an EBITDA margin attained in the current quarter of 38.6%. This was despite only one crude oil offtake being undertaken, and after having incorporated costs incurred for planned maintenance activities performed. From the United Kingdom segment, a net 144,000 barrels were sold from the Anasura cluster at $97.12 per barrel. In addition, gas sales delivered a revenue of 24.6 million ringgit. Gross profit from the Anasura cluster amounted to 61 million ringgit, whilst EBITDA realized amounted to 69.8 million ringgit. The strong profitability levels were achieved despite the conduct of the 2022 turnaround activities. The EBITDA achieved included unrealized foreign exchange gains of 12.4 million ringgit due to the period-end retranslation of the segment's Great Britain pound denominated balances. The US dollar, being the segment's functional currency, had appreciated against the Great Britain pound during the current quarter when compared to 30th June 2022. A new tax regime, namely the Energy Profits Levy, or EPL, was enacted on 14 July 2022 and took effect from 26 May 2022. It is an additional 25% levy on United Kingdom oil and gas profits, on top of the existing ring-fence corporation tax of 30% and supplementary charge of 10%. The group does not expect a significant additional income tax liability to arise from this regime as currently enacted. However, a deferred tax liability of 7 million ringgit was recognized in the current quarter, based on the taxable temporary differences expected to reverse during the window for which the current EPL regime applies, which is up to 31st December 2025. On 17 November 2022, the UK government announced changes to the EPL regime, which will come into effect from 1st January 2023. The revised EPL regime will include an increased levy rate of 35% on UK oil and gas profits, from 25% currently, on top of the existing ring-fence corporation tax and supplementary charge. This will mean that the UK upstream oil and gas industry will face a 75% marginal rate of tax. The enhanced deduction for certain categories of capital expenditure to offset against taxable EPL income will be reduced to 129%, except in the case of decarbonization expenditures, which will retain the 180% enhanced deduction. The EPL regime will now apply until 31st March 2028, and despite it being a tax on windfall profits, the UK government has stated that they do not intend phasing out the EPL even if oil and gas price levels move back to more normal levels. At this stage, our intention remains to phase our UK capital expenditure program such that we optimize the incentives offered as part of the EPL being imposed. The EPL amendments are expected to come into law before 31st December 2022. It is also clear that government is incentivizing decarbonization initiatives within the UK oil and gas sector, and this encourages us to identify further opportunities that will reduce our overall carbon footprint. That's all from me today. Back to you, Andrew.
Thank you, CY. And that is all we have for this quarterly earnings webcast. Thank you for tuning in.